I'll be kicking off the presentation today, followed by my work colleague Catherine Stiles and Lee Jackson. Do you want to give us a wave over there in the corner? And just a reminder again, we will all be at the back of the room at the end of this seminar if anyone has any further questions. Agenda for today. So we'll be covering off on a few different areas, specifically when might be the best time for you to retire, how much money you will need to retire, do you repay debt or build your super funds, and maybe some discussions around those different aspects. Building your retirement savings, and also discussing the different income streams you may get when you actually retire. And then finally, the power of financial advice. Tying all of this together with the guidance of a financial advisor to make sure that you're either on track to retirement or making the most of your retirement at present. Starting with the golden question that we get from most clients, when will I retire? Can I retire? Usually when you ask clients, when do you want to retire? I was saying earlier, yesterday is usually the answer. We want to retire as soon as we can. It's something you want to work towards and make sure you're prepared for. In terms of the retirement landscape, if we look back to the 1950s, we worked for a long period of time, and at retirement, we only lived for about 3 years before passing away. So the need to plan for retirement wasn't as big of an issue back then. Whereas today, at the moment, people are retiring a lot earlier, they're living for longer, and they're spending about 1/3 of their lives in retirement. So the need for a financial plan is becoming more and more important to make sure that your super funds, age pension, all types of income streams are going to actually cover you through till life expectancy so that you can maintain your lifestyle. Now, there are a few things that people worry about when it comes to retirement, including serious health problems, perhaps being a burden on your family, running out of money to live comfortably, not having a purpose, being lonely, and perhaps having nothing left to leave to your children. Does anyone in the room here feel like these might be concerning to you? When it comes to retirement, are you worried about any of these things? Perhaps, yeah, we've got a show of hands at the back there. Absolutely. And look, it's not uncommon. Most people have these fears. But the good thing to know is that at least you can put in place a plan that's going to help counteract some of these issues and give you that peace of mind that you can go through retirement comfortably without all these burdens. So we've spoken about potentially when you may be able to retire. This next section goes into how much money you may need to retire. Now, there's no golden figure that applies to every person. However, these next few slides will give you an idea of the average person's lifestyle and how much they would need in income per year to maintain that lifestyle in retirement. To give you an idea of retirement spending trends, this graph shows you that in the first stage, so if we have a look here, in between the age of 60 and 75, which is classified as the active phase, you're going to be spending the most amount of money because you've just retired, you're probably as healthy, in the best health that you've been in, and you're going to want to go and do all those extra activities, go on all those holidays that you perhaps couldn't do while you were still working. So that's where most of your expenditure that's where your expenditure is going to be the highest in retirement. Then you've got the second phase, which is classified as the passive phase. So this is generally between the ages of 65 and 85, and that's when your expenses start to drop a little bit, but you're also reducing your super balance, which means that you may need to rely a bit more on the age pension. So it's like a balancing scale. As you have less assets, your age pension goes up and vice versa, if you're eligible for the age pension, which is what Lee will cover off on later on in this presentation. Then the final stage is, unfortunately, the frail stage. Sounds a little bit morbid. However, the reality is that between the ages of 75 and 100, it's likely that your health may decline and your medical costs increase. So that's why you can see that the drop in expenses slightly starts to pick up again at that stage. How much is enough in retirement? Once again, that golden question. Just a reminder, there's no right or wrong. It will come down to your personal situation. If we look at statistics across the board in Australia, we've got a comfortable lifestyle and how much you'll need in terms of an income. So if we have a look at the left-hand side here, for a comfortable lifestyle, in order to receive around $70,000 per year in a couple, so if you're a couple and you want to live a comfortable lifestyle, it's about $70,000 a year that you will need. So that means that you need to have a rough super balance of around $690,000 as a couple. When it comes to being a single, to have a comfortable retirement, you need to be receiving around $50,200. So that is about $595,000 in terms of your super balance. If we look across to the modest side, so if you want to live a modest lifestyle, now on the next slide I will explain the differences between a comfortable and modest lifestyle. But in terms of a modest style, if you're a couple and you want to receive $45,900 a year in income, you need a super balance of around $100,000 at retirement. If you're a single and you want to live a modest lifestyle, that works out to be about $30,000 or just under $32,000 a year. Now you'll notice that the super balance is $100,000 as well, and the reason for that is because for a modest lifestyle, the amount of income that you require is close to what the age pension is. This total super balance is reliant on the fact that you'll probably get some sort of age pension, potentially, depending on your income and asset situation. Any questions on that or how that works?
Yeah, that's 70 grand. Is that tax free?
This is talking, so not necessarily, this is just talking about how much income you could get, whether it be from your pension, whether it be from the age pension, whether it be from share dividends. So it depends where that source of income comes from, which will determine if it's taxable or not.
But
so,
amount from our super, wouldn't
correct, good question. This will get covered off later on in the presentation as well. When it comes to retirement, if we're referring solely to your total super balance, you're in retirement, provided you meet all the conditions of release. Say, for example, you're 65 years age, you then transfer your super across to what we call an allocated pension and start drawing an income from it. The income you draw from your super is tax-free. Any growth on the investment earnings in super or the allocated pension phase is tax-free. So to answer your question, if you're talking about drawing this $70,000 purely from your super balance, provided you set it up correctly, which is why we encourage you to come and see us so that we can help you do that, you will receive effectively a tax-free income. But you need to make sure that you've got it in the right structure. So if you've got it in super, it may not be as tax effective. So just to give you an idea, when you're working and you're still building up your super balance, you're in what we call the super accumulation phase. So your employer's contributing to it, you might be putting money from your bank account into it and so forth. You then move to a stage where you might want to cut back a few days a week and semi-retire. You may want to start what we call a transition to retirement pension, which means you can access a small amount provided you meet the conditions of release, and then once you fully retire, you transfer the funds into an allocated pension, and then you can start to receive all of it tax-free. Now this is also, I should probably point out that this is based on an average rate of return of 6% per year. Obviously, if you're taking out money from this account, you want to make sure your investments are also working hard for you to top up those funds, to make sure that your funds don't deplete too quickly. Now I mentioned that the next slide, this one here, actually shows you the difference between the different lifestyles. Comfortable lifestyle, for example, might be you get haircuts every fortnight. I was saying earlier to my work colleagues, that's a bit like my husband. He's a bit precious and likes to make sure he's kept well, and every 2 weeks he's at the hairdresser getting his hair done. That might change a little bit later on in life. Whereas a modest lifestyle, which is the second column here, is you might say, I'll get a haircut once every month or every 2 months, as opposed to somebody who is just purely living on the age pension because they have no income and assets. They might say, I'll just cut my own hair. The differences in the lifestyle that you want to live will determine obviously how much income you need and also how much of a super balance you need at retirement. An Australian who is 65 years old today is said to live for another 20 or so years on average for a male. and just under 23 years on average for a female. So that's potentially another 20 years from now, and that sort of ties in with the figure that I mentioned at the beginning in terms of we're living longer, we're in retirement for longer, we need to make sure that our super is going to last. All right, another important consideration when thinking about retiring and how much money you might need is whether or not you want to support family members, whether it be adult children, grandchildren, siblings, or even your parents. These are all additional expenses that you may want to think about and perhaps discuss with an advisor or family to determine whether or not it's an additional thing you need to add to your retirement plan. By speaking to an advisor, all these little areas that you might not think of, I guess that's where we come in and we can actually make sure you're ticking all the boxes to make sure that you're putting in place a sound financial plan and there's not going to be any surprises. So we've now spoken about potentially when you may be able to retire, how much income you may need in retirement, and now we're moving on to a question that we get quite often from a lot of our clients, and that's, should I be repaying my home loan debt off, or should I be putting that money into super instead? Now, there's no right or wrong answer, and if you look at conventional wisdom, people used to say paying off your mortgage before investing more in super was the best thing to do. However, there have been super contribution caps that have been introduced, which means that gone are the days where you can say, all right, I'm just about to retire, so I'm going to vamp up my super fund now and put $500,000 into super. You cannot do that anymore due to the contribution caps. In some ways, you may be better off putting a lot more into super earlier and now so that you can get the benefits of getting more into super over that period, as well as the compounding returns from investments. So once again, there's no right or wrong. It all comes down to your specific situation that needs to be discussed and fleshed out. All right, so that concludes my section. We've covered off on how much, when you may be able to retire, how much you may need, some options around repaying debt or whether we should put that money into super. And we've got Kate, who will go through the next section of building your retirement savings. Thanks.
Right, so as Steph just talked us through, we know how much we think we hopefully can generate within retirement, how much we want to be able to have that fortnightly haircut if we want that, otherwise our wives might end up cutting our hair or vice versa, and I don't know who wants that, but now we're going to talk about how we can actually get to that level. For a couple, as Steph spoke about, that's $690,000, hopefully as a lump sum to be able to generate that comfortable lifestyle. So let's talk through a few ways that we can do that. Now, you'll notice throughout this, there are multiple ways of generating that lump sum. So it could be in your personal name. Some people do choose to do that. The ways that we're focusing on today will be about how to generate that lump sum within your superannuation fund. And the reasons for that are covered on this slide here. So as you can see on the first column, you've got your personal tax rate. So that's your marginal tax rate. Most of you who are working, the average tax rate is around 32.5% for most people. Within superannuation, your funds are taxed at 15% while it's in accumulation, while it's building up. That's obviously a pretty big difference straight up. If you've got any personal tax, any earnings on it, you've got that $690,000 invested, it could be getting taxed at 32.5%, in super at that 15%. And then when you eventually retire and we get to that pension account over here, we have this lovely zero figure. And that's what we all want to strive for. Everyone wants to pay less tax if it's possible, and this super pension environment allows us to do that. So that is why the strategies we're going to discuss on the next few slides will be all about generating it within super, building superannuation and not outside. There's 5 strategies that we're going to be covering today. There are more than 5. There's things as super spouse splitting, super contributions, things like that for spouses and splitting, but we're not going to go into that. We only do these 5. Superannuation is a very intricate area. There are a lot of different rules and regulations. Obviously, that keeps us in a job. The government's always changing the goalposts and changing things for us. So we're just going to try and cover the basics. As Steph said, we recommend that people come and talk to a financial advisor if you haven't before, because we can talk to you more about specifics for your situation rather than all the different things that might apply. We can just talk to you about what applies to you so it's less confusing. But the main things we'll be chatting about today is salary sacrifice, after-tax contributions, catch-up, concessional contributions, non-concessional and downsizer. So I'll start off with the fact that the laws have changed in such a way that you can't just go through life now and meet all your other expenses, get your kids off, get them through school, get your home loans paid off, do a bit of travel, and then all of a sudden go, oh, I want to retire in 5 years, let's chuck it all into superannuation now. Unfortunately, the government doesn't like us doing that, so they've put caps on the amount that we can get into superannuation. So this slide, it just covers what the caps are. It is in your pack for later on. It is covered on the next kind of strategies I'll discuss about, so I'm not going to go into it too much. But as you can see, you can put in 27,500 as a before tax contribution. So that's one that you can claim a tax deduction for. And then as an after tax contribution, you can do up to 110,000, or we can use 3 years worth of provisions and do 330,000 as well. And we'll talk through that a little bit more. The first thing that we saw on the slide was salary sacrifice. So this is one of the strategies that's used quite widely. Hands up if anyone's salary sacrificing at the moment. That's good. I'm glad I see quite a few hands up here. This is pleasing. This is what we want to see. Salary sacrificing is, as the name suggests, you're sacrificing some of your salary to put into superannuation to save for your retirement. So when you do that, it comes out of so you'll tell your employer, they'll set it up for you. It'll get paid straight into your super and you'll see it on your payslip. It doesn't come to you at any stage. So it also takes out the temptation for some people. They see 10,000 build up in their bank account and they go, oh, I've got 10,000 here. That's really great. Let's go on this holiday, or let's buy this new TV, or let's do this. It takes that away from you as well. It's more forced savings as well, which helps. But there is also, once again, this tax effectiveness that we can see up here. So contributions, when you put them into super, as a salary sacrifice, you will have to pay 15% tax on that amount as it goes into superannuation. But if we remember, as we talked about before, the personal tax rate, if it had gone into your personal name and you've been taxed from your employer, then you could have been paying up around 32.5% on those same funds. So it's still a tax saving, even though you are paying tax going in. Now that annual cap, as you can see up here in the corner, that does include, if you're employed on an employee basis, your employer will be making mandated 11% contributions on your behalf to your super. That is included in that 27,500 cap. So that's your financial year cap. That is included in that, and that is something to be mindful of. And then underneath in that kind of blue box, we talk about the fact that some people might not be employed as an employee. You may be self-employed. You may just have a lump sum and be under 67 and want to contribute to super. You can do that via a personal deductible contribution. So same thing, you've got that lump sum, you talk to an advisor or talk to your super fund, they can give you the code to put that into superannuation. And then once again, you can claim a tax deduction on that. So it reduces your taxable income from whatever you put in. That is another way of doing it. You can see up here though, as I said before, there's traps everywhere with this kind of stuff. It is a bit of a minefield. We can mention as much as we can, but you can contribute up to age 74 now, even if you're not working. However, you are still required to meet this work test, so 67 to 74, if you want to make that personal deductible contribution and claim a tax deduction. And another thing to mention as well is when you're claiming a tax deduction, you need to have taxable income to offset that against. Your taxable income is only $10,000 and you want to claim a tax deduction of $25,000, let's say. That's not going to work. You can only offset what you actually need to from that perspective. And when you do that, it then is counted as an after-tax contribution, so you can run into trouble with that. So once again, that's when we suggest you talk to a financial advisor to seek some more clarity about what works for your situation. This is just a little example of salary sacrifice. I've just done $50 per week for this one. Most people do choose to do more, but with cost of living and everything else going up at the moment, the best advice we give you is to start somewhere. So we've just looked at a base example of doing $50 per week. This particular person is earning $80,000 per annum, as we can see here. This line here, they're not salary sacrificing. This one here, they are. So if we look at the big difference, obviously down here, is you've got your different tax here. So they're salary sacrificing this, but they're paying less tax because of that 15% versus your marginal tax rate. That means at the end of the day, they're putting $50 into superannuation per week, but they're only going down $33 per week from the actual amount that goes into their pocket. So there's not that much of a loss. But the big bit here to look at is the net amount into super. So it increases by around 24%. So overall, you get a reduced, as you can see on the screen, you get the reduced take-home pay, you get a reduced tax payable, you get more into superannuation, and just for that $50 per week, it puts you in a position of, I think it was around $506 per annum better off. And as I said, that's a very basic situation, very base scenario. If you're looking at doing more than that, then that's obviously going to be a bigger, greater saving. If you look at that over a 5-year period with compounding interest, that's going to snowball and get bigger much quicker. But it's definitely something to start if you're not already, depending on your situation. Once again, that's something to chat to us about, but that's basically in a nutshell how it works. Now we're talking about it being in mind.
Sorry, Kate, I think we have another question.
Oh, sorry.
You're right. Go for it.
So after tax, not before tax?
After tax.
Yep.
The difference through the tax return. Is that a maximum of 27,500?
So anytime you want to claim a tax deduction for it, that is normally, and we're about to go into this, but the next slide, but normally it's that 27,500. But we are about to go into the next slide, which, as I said, it's a minefield. It makes it slightly different. If your balance, so that's a really good question to lead into this. If your balance is below this magical number of 500,000, you can now do what we're calling catch-up concessional contribution. So from 2018, that does allow you to do more than that 27,500 as a tax deductible contribution. So once again, super balance has to be below 500 for you, not as a couple, but just you personally, as long as that's the case. And you can change some stuff around, but as long as that's the case, then you can do this. So you can see on here, it's got to be able to through a rolling 5-year period. So you can see here, and this isn't a typo, this used to be the cap, the 25,000, and that's what counts still. This is the new one, so these are right. This particular person has put in either themselves personally or their employer, or together they've contributed a before tax, so a concessional contribution of $10,000 for the 5-year period. And that's all they've had surplus, that's all they're able to do. That then means the difference between the actual cap they had for each year and the unused amount that they haven't used equals here. So the first year, as you can see, it's just that flat 15,000. The next year, it actually ends up here. So we've gone here, they've still got 15,000 they didn't use, and it adds to this one before. And so you do that for that rolling 5-year period. And as you can see here, we end up with this really nice figure of 107,500. Now that's not going to be for everyone. Some years you might be able to, some you don't. But in this situation, there's then this figure. Now, apart from the fact that's fantastic because it means you can get 107,500 into super, and hopefully you've got that and can do that, and that's always fantastic. It also means that if you have a capital gains tax asset somewhere out there that you know you're going to incur at some stage, so an investment property you might be looking to sell in a few years, or a big share portfolio, or something along those kind of lines that you know it's in your personal name, when you go to sell it, you're going to have a capital gains tax. It means you can, once again, you have to be under this 500,000, but it does mean that all of a sudden you can put this amount in and claim a tax deduction with it, which will help offset the tax payable on that capital gains tax asset when you dispose of it. After tax contributions, the others were all pre-tax. This is after tax. You put it into superannuation after you've already been paid the income, you've already paid tax on it in your personal name. You then can put it into superannuation. It is a larger amount that you can put in. As you can see, you can put in up to 110,000 each, or we can use 3 years worth of that level and do 330,000. But then you can't do anything for that 3-year period afterwards. So if you did dispose of a big asset like the home, like an investment property like we were talking about earlier, you could then put all of those proceeds into superannuation as an after-tax contribution. Now, the advantage of doing something like this is, one, you get all those funds into super. 2, anything that goes in as an after-tax contribution goes into your super as a tax-free component of that superannuation. So within your accumulation accounts, you will have a taxable portion and a tax-free portion. And that taxable portion is made up of your salary sacrifice contributions, your employer mandated contributions, those personal deductible, any of those before tax contributions we were talking about before. What that means is when it passes to your spouse, it normally just passes along tax-free, where most people then leave it to their adult children who are non-tax dependents, and it's then taxed at 17% on that taxable portion of your super. Most people's super is made up of those pre-tax contributions. So most people's made up of your employee contributions and things. Let's say 80% of your super balance, when it passes to your adult children, they could potentially pay 17% tax on it. There are ways that we can structure things. There are strategies we can do to minimise that amount that is in your super as a taxable portion, make it tax-free. We can play with some things and massage some strategies to help out so the kids don't pay that. And once again, that's what we're here for. It's quite complicated to go into in a 1 hour session, so we won't. But ask us, come and see us for that meeting, and we can talk through those kind of strategies if that sounds like something that you would like assistance with, so that your kids aren't having to pay as much tax on your hard-earned money. Another thing underneath that you'd see here is we've talked about government co-contributions. If you are earning, and this magical numbers here, if you earn less than 43,445 and between, so then you get, if you put in $1,000, the government will match it 50 cents to the dollar. So if you put in $1,000 as an after-tax contribution, so a non-concessional contribution, the government will match that and put in $500 if you earn under this magical number here. If you earn over this number, they won't put in anything, and if it's between, then it's on a sliding scale. So it's just another kind of bonus that you can get if you find that you're under that, or your kids are, your young kids or something. If they put in $1,000 a year, government gives them $500. It's just another kind of thing to be mindful of. And you'll notice that when I was talking about contributing lump sums into super earlier, I was talking about investment properties and share portfolios, things like that. I didn't actually mention the residential house at any stage. That is, as you can see on the screen, because we now have a thing called a downsizer contribution to super. Has anyone here heard of that before or utilised it? Yep. There's a few people that put up their hands. There are restrictions on it. So as you can see here, you must be over the age of 55. You have to have owned the home for 10 plus years, and a few other things that I won't go through because it's on the screen for you. But basically what it means is if you sell your primary residence, you can put in up to $300,000 yourselves, and the same for your partner as well, of the sale proceeds into your superannuation. Now, it doesn't count towards those caps that we were talking about earlier. So it doesn't count towards that non-concessional cap, which means you can basically just get that extra amount into superannuation. So it's just another way that you can get lump sums into superannuation quickly as you approach that end of your retirement period.
Is there a time limit on that?
It's within 90 days. So there is that as well. And you can only claim it once as well, which is another thing to be mindful of. So sometimes if people have a residential home and they've also got an investment property and they know they're going to move to that investment property at some stage and turn it into the residential home, and it's worth more, you can have that discussion about whether or not it's worthwhile claiming it on that first house when they sell it, or on that second house if they've met the requirements and had it for more than 10 years and things as well. Any other questions on that? So I've covered how to build your super in a few ways. As I said, there's a lot more than what we've gone through. Mindful of the time, Lee's going to say what we can do once we get there.
Thank you, Kate. My name's Lee. Earlier on, I think it was only one person that put their hand up. You're the only one that's retired. Okay, so this next part is all going to cover off exactly where your income comes from in retirement. As advisors, we get a lot of questions talking about asking the question, when I get to retirement, what am I going to receive? How much do I need? Steph's already covered the topic about how long you'll be in retirement, how much you'll hopefully have to spend in retirement as well. So what I'm going to do is just cover off the three main areas of income sources when you get to retirement. First one is basically superannuation-based income. You've heard of allocated pensions, you may have heard the word pension streams, annuities as well. Lifetime annuity, term annuities. Second type of income stream you can likely have is income from things like term deposits, cash, term deposits, share dividends. If you've got some shares, you may have a rental property. Anybody here got any investment property? So you're well aware of the rental income that comes from that. And the third source of income you have in retirement can come from the government, which is basically age pension. So age pension, carers pension, and also disability support pension. I just wanted to go through some sources of income. So this was a study done a while ago, asking people over the age of 60 where their principal source of income comes from in retirement after the age of 60. So we've got the four main areas, or the three I've just covered: the superannuation income, investment income, and government pension, so age pension. There's also another fourth criteria, That's basically no personal income. And that's for people who are maybe over 60 and not getting an age pension or not getting a superannuation pension, or maybe relying on their spouse for their income. So if you look at the percentages of where people get their principal source of income, does anybody want to have a guess of which figure, without looking down at your sheets of the answers there, but does anybody have a bit of a guess about how many of the population over 60 have superannuation as their main source? Is it 70%? Anybody think that? No, not as high as that? Is it as low as 5%? Is it possibly 16? All right, well done. If you've looked, you don't get any prizes or anything like that. But yeah, only 16% of people over age 60 have their principal main income coming from superannuation. If we go through the rest, if we just click through, so income that's derived from, again, rental income from your investment property, cash from the bank, share dividends, that only makes up 9%. The biggest one is obviously the government pension. So a lot of people, when they get to retirement, their main source of income comes from the age pension. And I'll go through exactly how much age pension is in the next few slides. And obviously the last one is 5%. So now let's have a look at moving over to exactly how do you access your super. So Kate's spoken about ways of building your super, salary sacrificing, non-concessional contributions, all those wonderful ways of building your super. But when you get to the retirement, when can you actually access your super? This table here just basically says, well, it depends on when you're born. Looking around the room, if you fall into the category down the bottom there, if you're born any time after the 1st of July 1964, you have to wait until 60 before you can actually meet what's called a condition of release. Any time before 64, again, it's a sliding scale. Currently at the moment, the preservation is 59. If you do the maths on all that, if you're 59, you can actually start to access your super, even if you are working, which I'll cover off in a minute as well. When we get to talking about how do you access your super, if you've met the condition of release, if you've met that preservation age, most advisors will talk to you about converting your super into an account-based pension, or what we still know as an allocated pension. I'll just go through those now. So like your superannuation, your money's invested in whatever investment option you've chosen, whether it's something conservative, whether it's something aggressive, or something in between. So like your super, you've got choice on where your money's invested, and you can also choose how often you want that regular payment. So if you say, look, I'm happy to get a monthly payment, the advisor will set up your account in a way that basically every month you get money paid into your bank. It can be paid less frequently, it can be paid annually as well. You've also got the ability with an allocated pension to access the super and the accumulated balance as a lump sum payment as well. So we have this often with our client, that we've got a regular payment being paid to their bank account to pay their bills, but every now and again they'll say, I need to fix the car, or I need to buy a new car, or we've decided to go on a holiday, we've gone on a cruise, so we need a lump sum of money. So with an allocated pension, you can also withdraw a lump sum at any stage as well. One of the tax benefits of an allocated pension is that once your money is invested, if you're over 60, any money you take out, whether that's the regular pension payment or whether it's that lump sum payment, it actually comes to you all tax-free. So the way that this was in 2007, one of the benefits of having this pension stream is that the government decided to say anybody over the age of 60, once they withdraw money from super, gets money all tax-free. So it's a tax-free income. Also as well, on the third point there, when your money is invested in an allocated pension, when it grows with the market, so each year if you're seeing a good return, you've got an 8% return or whatever it may be, the investment earnings on that return are also tax-free as well. There's no taxation. If you were to grab one of your superannuation statements now and you look at the statement that says all of the money, what you started off on the 1st of July, and what it ended up at the 30th of July, one of the line items on there is one of the fees that come out, or one of the things that come out is tax. Because that tax is levied not just on the money that goes into super that Kate was talking about earlier, the 15%, but the investment earnings within that fund get taxed at 15% as well. When that money is in an allocated pension, it can still get the same type of return, a 6 or an 8% return, but there's no tax on any of those earnings. So if you think about your rental property or your share dividends that you've got, keeping in mind that any dividend or any rental income you get is taxed at your marginal tax rate. When the money grows within that investment, so again, if you were to come and look at selling your investment property, you've got capital gains tax issues, which is a good problem to have. You want to make money, you want a capital gain, you don't want a capital loss. But keeping in mind that if you have that money, instead of sitting in bricks and mortar, if you have that money sitting in an allocated pension, you can draw it at any time, you can sell it down, and it's completely tax-free. So there's no other investment vehicles of holding your wealth that is offered in a tax-free environment in that space. Keep it in mind as well, with that table down the bottom there, that you also have to abide by the rules that basically says when you've got your money in an allocated pension, you've got 100% access to it at any stage, but over the space of a year, you have to take out a minimum amount as well. So that's a nice simple calculation. On the 1st of July, the allocated pension says, okay, your balance on the 1st of July was X amount of dollars. For the next 12 months, until the 30th of June, you have to take out X%, depending on the age you were at the 1st of July. So if you're 65 to 74, you have to take out 5% of your balance over the coming 12 months. Now, whether you take that out on a regular monthly basis, or whether you take it out at all in one go, as long as you've taken out 5%, or the percentage for your age, at the end of the financial year, everything's all good. There's also limits on how much you can actually have in a pension. You may have heard something in the news a few years ago about how much you're allowed to have in this concessionally taxed environment in an allocated pension. It's called the transfer balance cap. It's a problem if you've got over 1.9 million that you want to have. It's a pretty good problem to have, but basically anything above 1.9 million, you can no longer have it, or you can't start your pension with more than 1.9 million. It can actually grow above that, but when you start your pension, you can be no more than 1.9. Anything more than that has to stay within the superannuation accumulation phase, which has that 15% tax environment as well. Any questions on that?
Person? 1.9 million per person, right?
Per person, yes, in total.
So you mean in total, as a couple, you get 3.9 million?
Yes. And that's the sum total of all the accounts. So quite possible as advisors, we have multiple accounts for one person for different tax reasons and so forth, but it's the accumulated balance.
Another question is, this is converted from 60 years old, and how do you actually get the money into, you have to convert all your income and into super first to convert this money, or can you contribute later on?
No, you can't contribute directly into an allocated pension. You can only contribute into the superannuation first, and then as the advisors, we transfer that across into an allocated pension. If at any stage you come into further funds, or you decide that actually you want to go and add more money in, we have to basically commute it, roll it back from an allocated pension back into superannuation, contribute into super, and then roll it back into a new allocated pension. It's a little bit of a...
Also, there is a limit to an age limit of when you can contribute up to the ages of 75. So depending on the contribution you're making, there are certain ages that you can contribute to super until you can no longer do that. So if you were 80 years old and you came across an inheritance or some funds, you may not be able to get that into super because of restrictions. But as Kate mentioned, with the downsize of contribution, if you sell...
Only after you retired, you said?
Yeah.
Effectively, yes. You can actually have an allocated pension and not be retired, and I'll cover that in this next slide as well. But effectively, yeah, when people say, okay, I've had enough of work, I'm completely stopping, say, great, what have you got in super? Let's see about transferring that across into an allocated pension and start to pay
Can
you.
you run them two side by side?
Absolutely you can, yeah. And this will be right now. It's called a transition to retirement. So we've got a couple of scenarios here. The first one is, as I mentioned before, as an example, is that you want to cut back work. You want to go from, say, 5 days a week back down to 3. You've had enough. You don't want to fully retire. You don't want to fully stop work. We just want to cut back on the amount of days that we are at work. Obviously, that means that you've got to cut in your salary as well, in your income, because work's only paying you for 3 days. You top up your income through converting your superannuation into an allocated pension. Technically called a non-commutable allocated pension if you haven't met the full condition of release there, but you can actually access that superannuation and supplement your income whilst easing into retirement and just working part-time. So the same rule applies for this transition to retirement pension in terms of the amount that you draw down. you have to meet that minimum drawdown, but instead of having 100% access to it, because you're under the conditions of this transition to retirement, you can only access a maximum of 10%. So the government limits exactly how much you can access whilst still doing this condition of part-time work. Kate mentioned earlier about having the salary sacrifice. One of this other strategy, the strategy of transition to retirement also works for clients who are actually still working full-time and they want to maximise their super contributions. Kate said before that salary sacrifice, a great tax-effective way to put money and build your super, but obviously that comes at the cost of you not getting as much into your bank account each pay period. So again, what we do there is we top up your income by starting this transition to retirement pension as well. Next slide changes the mood a little bit, but we're going to often get questions asked from clients about, well, what happens to my super when I die? Who gets it? There's a lot of concerns that if people don't make a nomination or they've got the wrong nomination on their superannuation or their pension fund, they don't have a nomination, they sometimes think that that money gets left to the government. Does the government get it? The short answer to that is no. It always goes to your family, to your next of kin. Assuming you've got next of kin. But basically, under the rules of superannuation, because it's set up as a trust structure, the trustees of the super fund are the ones that are legally bound to pay your superannuation to the right people, to the right superannuation dependents, and also to the right tax dependents as well. So when we talk to our clients about making a nomination, there's a couple of ways of who we nominate. You can either nominate a specific person, so your spouse. You can also nominate more than one person if you've got other people you'd like to, but we sometimes shy away from that because there's some tax issues about money being left to non-tax dependent adult children. A lot of people think, I'll leave it to my kids, but your kids are now adults. And the problem with that is that once that money gets paid to the adult children, there's a whole lot of tax that needs to be paid on some of the components to the tune of 17%, not 16.5%, not 17.5%, 17%. So the nomination is who do we leave it to? So we're not solicitors, we can't give you the legal advice on this, but we know that leaving it to the spouse is one of the preferred ways, or if not to the spouse, you leave it to your estate. So what's called your legal personal representative, your LPR. And that's basically that you saying to the trustees, if I pass away, pay the money out into my estate, and that I've got a will, let the will handle it to make sure that it gets paid to the right people. Under the nominations, where the non-binding and binding, just to explain that a little bit more, a non-binding nomination is where the trustees say, okay, the person who's passed away, they said they want to leave it to their spouse or to their estate. Before we pay it to them, we just have to make sure that is the best, or that's the most appropriate beneficiary for that nomination. And because it's non-binding on the trustees actually then have to write to the next of kin and the potential beneficiaries for them to sign off that they're quite happy for the money to be left to, say, the spouse. Because of that extra time involved, a non-binding nomination just makes things a lot more time-consuming, and it can span out over the space of months. Whereas if you do leave a binding nomination, because it's a binding obligation on the trustees, if the super fund says that it's been left to the spouse or left to the estate, then the trustees will have to pay that to that person. As long as the spouse is still alive, your estate is always there, so the money will get paid to that beneficiary. Question? We've got an accountant in the room. I'm looking at that man over there. Look, generally, it depends on who is the beneficiary of that money eventually as well. It's sometimes how you say, the tax, as you're probably well aware, that the tax office tries to close every type of loophole and make sure that they get their fair whack of tax as well. But yeah, if the money's left to the adult children, eventually they still pay that tax on that super part of it as well. I think we all know that when it comes to the tax matter, that all the loopholes and all the things you're able to do are now closed. All right, so that's basically talking about superannuation as an income stream in retirement, about how to access it. So let's talk about that other income stream that we said earlier that represents 70% for people of their principal source of income. So age pension, so what is it and how much and how does it all work? So at the moment, if you're a single person, not a couple, but a single person, the maximum age pension that person can get is just under $1,100 a fortnight, which is, over the space of a year, $28,500. So not a lot to live off, and that was what Steph was saying earlier about how much can I have in retirement to live off. as a comfortable retirement or as a modest retirement, keeping in mind that a modest lifestyle requires an income of around about 32,000. A comfortable lifestyle can be all the way up to 50. Looking at a couple, same thing applies as well. The maximum rate that they can get as a couple is just over 826,000, which is around about 43,000 combined as well. Now, don't be confused, because we sometimes have a husband and wife that they reach age pension at a different age to the other one. That doesn't mean you're classed as a single age pension recipient. You're still classed as a couple, and all your assets and income are counted together as a couple, but effectively you'll come under the couple rate set as well. So the eligibility for age pension, how does that work? Like super in terms of when you can get it, it depends on when you're born. If you may remember, females used to be age pension age at 60, and then that slowly moved up to 65 to meet up to the same level as men. Now 65 has now been pushed out to 67. Common misconception a lot of people have is that they think that because in the media people talk about 67 as the retirement age, that you can't retire until 67. You can retire whenever you want. Whether you've got enough money to retire is another thing, but retiring whenever you want is different to reaching age pension age. So currently at the moment for most people it's 67 years old, and when you get to 67 that's when they apply 2 tests. So I'll now explain that. It's called an income and an asset test. So the first test is the income test that we look at, and it's basically a sliding scale. Centrelink say, give me a list of all your assets and all your income that you currently receive. When they look at the income, they say they don't actually care how much money you're receiving from, say, your term deposits. They don't care exactly how much money you're getting from your share dividends. They use that asset figure and they pretend it earns at what's called a deemed income, which are those figures down the bottom. So you can have all this money sitting in shares in the bank and also your superannuation or your allocated pension. They don't actually care exactly how much you get from it. They just pretend it earns interest at those rates. So as a couple, the first 100,000 of your assets, your investment assets, is deemed to earn 0.25%, and then anything above 100,000 is deemed at 2.25%. So you could be earning 6% in your 8%, you could be earning 4% in your term deposit. They basically say that we don't care how much you actually earn, we're just going to pretend it earns this much. You may also still be working, you can still do a little bit of part-time work whilst you're in age pension age, and they will count some of that income above a certain threshold. But the bottom line is that when they look at all of your income that you receive, plus the deemed income, as a example, if you're for the fortnight, if your income is more than $360 for the fortnight, or up to $360, you'll get the full age pension, which is at $826 per fortnight we mentioned before. As soon as your assessable income goes over $360, all the way up to $3,666, you'll get a sliding scale of age pension. So if you're right on the very upper limit, that's when you basically get $1 or $2 in age pension. If you're somewhere in between, again, you're on that sliding scale. So that income test is the first test that they apply, and that will determine how much age pension are you able to get. Then they also then apply the assets test. And similar to the income test, it's a sliding scale. So again, let's look at a couple. So a couple combined can have up to $451,500 in assessable assets. But what's an asset? Here's the question at the back. What's an asset? Basically, the asset value is everything you own effectively except for the value of your home. It can sometimes, with other exceptions, it can also include, not include I should say, your spouse's super. So let's say you've reached age pension age, but your spouse hasn't. Their superannuation balance isn't included in the assets test. So one of the common strategies we have as advisors, if we've got a bit of a discrepancy between age pension ages, is we can actually do a little bit of shifting of funds to lower your assessable assets. Because under an assets test, if you let the super say in one account that was assessable, you may not get any any age pension, or you may get a reduced amount. But by shifting that money across from one person's super into another, being aware of contribution limits that Kate mentioned before, assuming we can shield that money from assessment, it's completely legal, there's nothing untoward about it. You can actually move that superannuation from one person to another and maximise your age pension test. So the assets test can be that 451,500 will get you the full age pension all the way up to 1 million, just over 1 million, and that's when you get no age pension. So again, like the income test, it's a sliding scale. Now, of these two tests that apply, whichever one is the one that gives the worst result, lo and behold, that's the one that Centrelink say that's the one we're going to apply. So it's quite common to have clients that may say have a lot of assets but no income, and they may fall under the assets test, and conversely it could be the other way where somebody hasn't quite got a huge amount of assets but they may be receiving a pension income, say from overseas, or an income stream from work, so they've got no like a lifetime annuity. So whilst they don't have access to a large amount of assets, it's the income test that they fall foul on as well. Any questions with that one? Straightforward? Then? Bit complex area when we come to do the calculations, but similar to the ATO, when it comes to Centrelink, there's not a lot of stuff that you can do to actually legally shield your money from their assessment, apart from moving money from one to another for a spouse. The rest of the time, they even limit the amount of money you can gift as well. Have everybody heard of gifting? You can gift money to whoever you want, to your advisor even. You can. So the first 10,000 you can gift away, and Centrelink don't count that. But anything above 10,000, so you can give 100,000 away to a family member to help buy a house deposit, but of that, the 90,000 is still accessible for 5 years. So all the old loopholes you could get around, that's all been closed off there as well. Complex area, and then again, that's why we encourage everybody to have a chat to an advisor, because as an income stream in your retirement, age pension is probably going to play a big part. So you've got to get it right early. Let's just have a look at the concession cards as well, because a lot of the time when we talk to clients about are they eligible for age pension, if they are, the great thing that comes along with age pension is the pension and concession card. So the pension and concession card is the one that, apart from maybe Barb, hello again, did you get a card? Did you get it? Okay, all right. Let's say Barb gets the card. Barb's got this wonderful purple bluey coloured card there as well. That's the one that give you all the discounts and so forth, and I'll go through some of those, what those discounts are as well. But by far, that's the pension and concession card is the one that we want our clients to try and receive if they're within the means of the income and the assets test. But if they can't meet that criteria of getting an age pension, you don't get the pension and concession card. When we have clients that maybe just, let's say for instance, they didn't receive age pension because of the assets test, but because they've been spending money or they've gone overseas on a holiday, or maybe because the market's declined and their assets all of a sudden fall below that 1 million mark, all of a sudden they're eligible to apply for the age pension. And that's where as advisors we say, let's take advantage of your lower assets. Let's get you just $10 worth of pension per fortnight, because what comes with it is that wonderful card there as well. If that's not the case though, what we can look at doing is applying for what's called the healthcare card, and it's issued to clients under what's called the low income assessment. So it's income tested. If we can't get you that, and I'll go through the figures on those as well, if you can't get the healthcare card, you're basically going to fall back on the Commonwealth Seniors Healthcare card, which when it comes to discounts and so forth, it's not quite as good as the other two cards, but it's at least something that you can try and use to get concessions wherever possible. So in terms of the eligibility of each concession card, the pension and concession card is obviously based on your age pension. It's usually valid for 2 years, and it's automatically reissued every 2 years as well. Healthcare card, the green one, is based under that the low income test. When we initially apply for it, Centrelink look at your income over an 8-week period. And as long as it's below a certain threshold, then you can get the healthcare card. The income that's included is employment income, rental income, deemed income from super and allocated pensions. And if we can get you that, then we fall back on that Commonwealth Seniors, which basically has an income limit on whether if you're a single or a couple. If you're looking at a couple, you can have up to $144,000 worth of income in a year, which is a significant amount, and still get this Commonwealth Seniors Healthcare card. So to put them all into perspective in terms of what are those discounts, so the first column there is obviously the pension and concession card. That's also issued as well under the Veterans Affairs, so people who've got a DVA pension, they also get that concession card. Green, the healthcare card, the low income, then the Commonwealth Seniors. We've also got the last column. This is also a printout in your pack as well. We've also got at the end as well the Commonwealth Seniors card. That's the Victorian government. Anybody over 60 can apply for that, and that's the one that gives you the discounts on travel, on public transport, gives you discounts at the bistro next door, under the seniors menu, all that type of stuff as well. So with the pension and concession card, you can see all those ticks in the boxes there. That's the one that gives you all the discounts on your rates, your home rates, your electricity, your gas, your water, your car rego as well. So you get a 50% discount on the component in your rego, so you're effectively only paying $400 odd instead of $800. The healthcare card, if it's issued under low income, also offers similar types of concessions. Not so much on the rates with the council. And then you can see on the Commonwealth Seniors Healthcare card, that's why look, it doesn't give you the most, hardly gives you any discounts at all. And I say to my clients all the time, look, just flash it wherever you can to see if it works. Because still some corporations still allow you to actually get a bit of a discount in some areas. As for us as Freedom Financial Planning, we pretty much can cover any area of your situation. So that's talking to you about superannuation and how that's in the lead up to retirement. How about your investments? Talking about Centrelink, what I was just talking about before, age pension and so forth. Insurance is perhaps if you're a bit younger, there's some younger faces in the crowd there, but insurance is so like life and disability insurance. So we can cover off on that as well. And aged care, which is becoming increasingly more, popular, it's not like you choose, it's becoming increasingly more a big part of our business, where we're talking to our clients that maybe need to get some aged care, need to get some assistance in living. And that's another area where we haven't touched on today, but that's an area where we're finding more and more people that are requiring advice. You may have noticed, I know two people you almost noticed and thought they'd come to the wrong presentation, but we've also got another part of our business called Freedom Mortgage Solutions. Sean, who's not here at the moment, I think he's actually out signing up loans at the moment, I'm not too sure, but he's not here at the moment. But another part of our business is if you sign loan and you're looking to get it refinanced, or maybe you've got your sons or daughters or even grandkids looking at buying their first home, in the pack you'll see one of the little green flyers there. That Sean little flyer. By all means, we encourage everybody to have a chat to Sean. It's always worthwhile in the last 12 months or more, with home loan rates increasing quite significantly. A lot of people are looking to refinance to try and minimise that. We went from 1 or 2% to all of a sudden 6 or 7% in terms of rates. Sean's the man when it comes to looking at refinancing. When do you look at? Again, mentioning that we've got a few different ages and faces here. When do you see, when's the best time to see an advisor? Really the best time is always now. Don't leave it until you're getting closer to retirement thinking, oh, the next few years I'll start talking about maximising super. You need to start thinking about it now. The earlier you can act on any kind of advice, the better it is for the future. So whether you are in the early ages of 20 to 30, and again this also applies to your kids or grandkids, keep in mind that their situation, they may need to talk to an advisor about all those different areas of their situation, all the way through to where we are talking about retirement from the 60s and the 65s as well. So if you were to come and see an advisor, what do you expect? If you've never seen an advisor before, our business is all built around our ongoing advice to all of our ongoing clients. Barb's been with us for a while, Barb. Ryan, you've known Ryan quite a few years. And our ongoing advice service is probably the most important part of anybody's advice journey, because once we put something in place, you need to tailor it and make sure it suits your situation as your life changes as well. So when you come to see us for the first time, our first meeting, Steph mentioned it earlier on, there's no cost, there's no obligation, there's no high pressure sales by any means. We just want to sit down, get to know you, work out where we can help you, and you need to make sure that you're comfortable with working with the advisor as well. We do have a fee once we take it to the next step. So if you were to say, yes, I'm happy with what you've got to say, I like the ideas of doing A, B and C, let's talk about taking to the next step of getting formal advice. And that basically is where we then go away and say, we'll charge this amount of dollars to provide a strategic advice plan. And we go away, do all the background research, working out what's the best thing. Should you be salary sacrificing more? Is a TTR strategy important for you? All those strategies we've spoken about, plus more, that's when we sit down and work out what's the best thing for you. We then put that together in what's called a statement of advice. It's a nice thick plan that's literally 50 or 60 pages, thanks to the government over the years. What used to be a simple thing of let's do this and here's a few forms has now become war and peace in terms of the advice document. So once we prepare the plan, we put it together, We obviously sit down with you and go through it. We then implement it. We do all the forms, many forms. We don't expect any of our clients to do. That's all part of our service, including Centrelink as well. So nobody likes dealing with Centrelink. Certainly we don't like dealing with Centrelink, but we do. But basically we handle all of that part of everybody's situation for them. Once we've got it in place, again, building on this ongoing advice structure, we want to make sure that your situation is reviewed. So at least on an annual basis, possibly even every 6 months, could be even every quarter, depending on your situation, what's changing over the city. We need to meet with you and make sure that what we've implemented is still appropriate for you. Again, governments can come in and they can change rules. They can now say, we can now do this. So then again, we go back to our clients and say, let's look at reviewing what we've done previously, because maybe we need to change something in the future as well. So that's us in a nutshell. So I want to thank everybody for coming tonight. Thank you. If anybody's got any questions, you're more than welcome to shout them out now, or grab myself, Kate, Steph, or even Mark sitting in the back there as well. We're all advisors, we can give advice, so by all means feel free to ask what you'd like. Thanks for coming.